What if I told you that there are people who made billions of dollars by going against the crowd, betting everything on events that no one else foresaw, exploiting flaws and inefficiencies in the market when others remained willfully ignorant, and in doing so, amassed fortunes beyond most wildest dreams? In this video, we discuss about the 10 traders who went God mode and pulled off some of the most legendary trades in history. Up at number 10, we have Michael Burry, the Big Short. The housing market was in the midst of a bubble in the mid-2000s, fueled by low interest rates and loose lending standards. Mortgages were being bundled together and resold as securities, with credit rating agencies often overstating their quality. Michael Burry, a hedge fund manager and founder of Swan Capital, recognized the signs of an impending crisis. While others were optimistic, he delved deeper and saw the underlying risks piling up. Burry decided to make a massive bet against the housing market through credit default swaps. This would pay off handsomely if the mortgage-backed securities and collateralized debt obligations based on these risky loans started defaulting en masse. It was a huge contrarian trade that faced skepticism from investors accustomed to rising home values. Burry had to convince them to stay the course as losses mounted. He was battling the entire system alone. But Burry's vision proved prescient. The bubble popped in 2007 to 08, with catastrophic consequences. As foreclosures snowballed, the securities collapsed and defaults triggered Burry's swaps. He netted over 700 mil, cementing his status as a trading legend. While the economy crumbled, Burry had triumphantly called the moment the whole market was blind to. In a crisis of massive proportions, one investor attained God mode by seeing what others could not. And number 9, Bill Ackman, the man who cried Wolf Street. Bill Ackman was a renowned activist investor and founder of Pershing Square Capital. One of his biggest bets was to expose what he saw as fraud at Herbalife, a multi-level marketing firm selling nutrition products. Convinced Herbalife ran an illegal pyramid scheme, Ackman launched a massive public campaign. He released report after report detailing the deception and exploitation of distributors. Regulators, he predicted, would soon shut the company down. All in, Ackman shorted over $1 billion worth of Herbalife stock. This meant profiting if shares fell after his allegations proved true. But Ackman was waging war virtually alone on Wall Street. His campaign raged. Other titans like Carl Icahn and George Soros took the opposing view. They accumulated Herbalife shares, defending its business model against Ackman's assault. Where Ackman saw a house of cards, they saw a legitimate enterprise. As their backing lifted the stock, Ackman became trapped in an increasingly costly position. What was to be a crowning moment ended in an over $1 billion defeat. Though certain of his analysis, Ackman had badly misjudged the market response. In betting against an entire company, he attained not God mode, but mockery as the man who cried Wolf Street. At number 8, Nassim Taleb, the Black Swan Hunter. Nassim Taleb is renowned for his ability to profit enormously from unpredictable events, known as black swans, through his strategy of hunting for them in the markets. One of his most famous trades involved a major short position he took against Herbalife in 2014, betting that the company was operating an illegal pyramid scheme. Taleb amassed a huge short position in Herbalife shares, equivalent to billions of dollars, convinced that regulators would eventually shut the company down for its questionable business practices. He publicly declared his view that Herbalife was a fraud, and that the stock would inevitably collapse to zero. However, things did not play out as he expected. As his short position grew even larger, racking up massive potential losses, Herbalife's stock price remained stubbornly high. Other prominent investors like Carl Icahn and George Soros took the opposing view, arguing the company was legitimate. They accumulated long positions in the company that directly opposed Taleb's short bet. As these high-profile clashes played out in the media, the stock market appeared to be siding with Icahn and Soros over Taleb. The pressure mounted on Taleb as each day passed without regulators intervening against Herbalife. His short position, which was intended to profit from a black swan event, had instead become a huge risk exposure. Losses on the trade were accumulating into the billions, where Taleb had once profited enormously from correctly predicting low-probability disasters. He now faced the real possibility of a devastating loss if proven wrong about Herbalife. In early 2015, after over a year of battling the stock in the markets, Taleb was eventually forced to concede defeat. He covered his massive short position at a loss of over $1 billion, one of the largest losses from a single trade in Wall Street history. His confidence in identifying black swans and profiting from them had met its match in the stubborn resilience of Herbalife. It served as a humbling reminder that even the greatest forecasters can be blindsided by the unpredictable. Number 7. George Weiss, the god of charting. In late January 2020, a bullish technical pattern had begun to emerge in the Nasdaq 100 mini futures contract. After declining sharply from its recent highs, the index had spent several weeks moving sideways in a tight trading range between 9,000 to 9,100 points. On the daily charts, the upper boundary of this range at 9,100 had formed a clear area of resistance, halting multiple upward attempts. Momentum indicators on the charts, such as RSI and stochastic oscillator, were now signaling that downside selling pressure was abating as both moved up from oversold levels. Volume was also starting to pick up, as buyers tentatively tested the resistance level from below on higher highs. This combination of bullish technical signs pointed to the growing potential for an upside breakout. On February 7th, the buying influx dramatically accelerated. A surge in demand overwhelmed sellers and drove prices above the psychological 9,100 resistance barrier in one smooth upward thrust on heavy volume. By the close, a sizable gap had opened above 9,100 to continue the bullish momentum into the new week. The following Monday saw the gap fill rapidly as buying enthusiasm took hold. Further buying pushed the index to new heights above the breakout point, reaching 9,200. This ignited a sustained rally over the coming months as work-from-home stocks soared on the back of COVID-19 lockdowns. The initial technical breakout from the range snowballed into a major bull trend that rewarded those who had caught the early signs. At 6, David Tepper, the king of Wall Street. In early 2009, the global financial system was still reeling from the collapse of the Lehman Brothers and the ensuing credit crunch. Major banks had written down billions in losses related to subprime mortgages and other toxic assets. With the economy in recession, many investors remained wary about the stability of the entire sector. However, hedge fund manager David Tepper had a contrarian view. Analyzing the situation, he concluded that the US government would not allow the largest banks to fail, given their systematic importance. But with markets in panic, their shares had been indiscriminately sold down to deeply undervalued levels. Using his Appaloosa fund, Tepper began quietly accumulating large positions in banks like Bank of America, Citigroup, and Wells Fargo throughout 2009. As other investors fled the sector, he was buying their bonds and stocks at pennies on the dollar. His timing looked questionable as bank results remained dire and bailout fatigue set in. Then in March 2010, signs emerged that the banking crisis had truly passed its worst. The US Treasury initiated a stress test of major banks that showed most were adequately capitalized. Tepper's conviction was vindicated. With government support, the banks had turned the corner despite lingering problems. What followed was a massive relief rally, as investors realized the doomsday scenario had been avoided. By 2013, Tepper had netted an estimated $7 billion in profit from his bank bets, cementing his reputation as a master analyst and trader. It remains one of the most successful sector plays in Wall Street history. Number 5, Jim Simmons, the codebreaker. Jim Simmons is renowned as one of the most successful hedge fund managers of all time thanks to the phenomenal returns of his medallion fund. In the 1980s, after a distinguished career in mathematics and code breaking for the government, he founded Renaissance Technologies to apply rigorous quantitative analysis to financial markets. Rather than relying on traditional stock picking, Simmons developed sophisticated mathematical models and algorithms to score troves of market data for patterns and trading signals. His firm hired an elite team of scientists and programmers to continuously refine these models using cutting-edge computer power. One of Renaissance's most lucrative strategies involved high-frequency trading. By the 1980s, Medallion was executing thousands of algorithmic trades per minute to profit from tiny pricing anomalies. Over decades, this systematic approach compounded eye-watering average annual returns north of 60%. Simmons's quaint focus and secrecy surrounding Renaissance's strategies led to much speculation on Wall Street. However, the results spoke for themselves. By the 2010s, Medallion had grown to over $50 billion in assets despite keeping most of its methods closely guarded. Its multi-decade run as the most successful hedge fund ever stands as a testament to Simmons's brilliance in quantifying the markets. At 4, John Paulson, the greatest trade ever. In 2007 to 08, as the US housing market was showing signs of instability, John Paulson recognized an opportunity, fueled by years of low interest rates, loose lending standards, and the bundling of risky mortgages into securities. Housing prices had inflated into a bubble. Paulson believed the bubble was on the verge of bursting. They also believed credit ratings agencies had overestimated the quality of mortgage-backed securities, MBS, and collateralized debt obligations, CDOs containing bundled mortgages, betting the bubble would pop. They took a short position on MBS and CDOs using credit default swaps, CDS. CDS are contracts that pay out when the underlying security defaults. The investor also created their own CDO, called Abacus, designed to fail, and sold it while purchasing CDS to profit from its inevitable downfall. When the collapse finally came, the housing market plunged and MBS CDO values tanked. Widespread defaults triggered large payouts on the CDS bets. This proved a hugely profitable trade, netting over $15 billion at the expense of MBS CDO holders and the ailing economy. Dubbed the greatest trade ever, the Abacus CDO later drew scrutiny for its design. Nonetheless, this trade successfully navigated the downturn, capitalizing on vulnerabilities that ultimately shook the financial system. 3. Paul Tudor Jones, the trader. In 1987, Paul Tudor Jones recognized signs of instability in the U.S. stock market. Years of gains had made investors complacent, yet key indicators like sentiment, technicals, and historical patterns in Jones's analyses resembled those before the 1929 crash. Jones believed the bull market had run too far, too fast, under the influence of overconfidence, leaving the market vulnerable. To leverage his view, Jones took a sizable short position in stock futures and options through his fund, Tudor Investment Corporation. Stop losses were also implemented to protect potential profits if a rally occurred. On October 19th, Jones's predicted catalyst struck. Interest rate hikes, trade deficits, and an automated selling system combined to trigger a panic. The market plunged 22% in the largest single-day decline ever seen. As widespread losses ensued, Jones's well-timed short position generated over $100 million in gains for his fund. Dubbed the trader for his predictive success, Tudor specializes in navigating global macro trends and political events to profit from uncertainty. Jones's foresight, risk management, and ability to profit from looming downturns through his analysis earned industry respect. It also supported philanthropic work addressing social and environmental issues. In his seminal trade, his macro insight transformed a crash into a landmark triumph of prescience over sentiment. At number 2, George Soros, the man who broke the Bank of England. In 1992, a controversial hedge fund manager exploited vulnerabilities in the British currency regime for massive gain. George Soros observed the UK pound was overvalued within the European exchange rate mechanism, fixed artificially to the German mark. Soros believed Britain could not sustain this valuation and would be forced to devalue or exit the system. To leverage this view, he covertly amassed a huge short position against the pound through aggressive borrowing and selling. Soros also reportedly convinced other traders to join his bet, amplifying downward pressure. On Black Wednesday, the Bank of England fought in vain to defend the unsustainable peg, raising rates to astronomical levels. Yet massive intervention proved no match for Soros' market manipulation, estimated at over $10 billion in short sales. After burning through $3 billion in reserves, Britain surrendered the peg in a costly devaluation. While the UK economy suffered the fallout, Soros profited over $1 billion from his scheme. Critics argue his speculation directly precipitated the crisis, with some labeling it an assault on British sovereignty. However, his success cemented his reputation, for better or worse, as the archetypal hedge fund currency killer. And at number 1, Jesse Livermore, the boy plunger. In the early 20th century, Jesse Livermore exploited market volatility to amass legendary fortunes, though instability would prove his ultimate downfall. Starting young, he developed a preternatural ability to anticipate trends through technical patterns. Using this gift, Livermore notoriously shorted the 1907 panic for $3 million, presaging the crash. 2 decades later, he again timed the 1929 collapse perfectly, netting over $100 million amidst the ensuing depression. Critics argue Livermore's speculation directly contributed to the economic turmoil, with some accusing him of manipulation for profit. Dubbed the boy plunger for brazen bets, Livermore flaunted daring rules like cutting losses quickly. However, hubris saw his fortunes also fluctuate wildly. Several bankruptcies resulted from reckless over-leveraging and volatile markets. Further, legal issues and personal demons plagued the legendary bear's later years. Ultimately, Livermore's sordid story serves as a cautionary tale. While his predictive acumen proved hugely lucrative, an inability to check risk-taking led to ruin. That his life ended in suicide indicates the heavy psychological toll of gambling fortunes on capricious market waves. These legendary traders went God mode, betting billions against the crashing market. Their epic trades are the stuff of legend. They showed it's possible to beat the odds with skills, strategies, and conviction. No, not easy. With courage and discipline, anything's possible. Apply these lessons to trading, investing, and life. Study failure to succeed. Stay calm in the chaos, and subscribe.